Today, we're going to look at a property in Jacksonville, Florida that has been fully renovated, has an estimated property taxes under $2,500 per year, will generate positive monthly cash flow, and we're going to see it through the eyes of an amateur real estate expert that is joining us today. We're officially live on Facebook for the Thursday edition of the Not Your Average Investor Show, the JWB Rental Income Property of the Week. I'm your host, Pablo Gonzalez. With me, as always, the man that I call GC because he's got genius concepts. He generates cash flows. He's a great co-host, and because his name is Gregg Cohen. Say hello, Greg.
Hey, everybody.
And with us today is a JWB client, esteemed member of our Not Your Average Investor Show community, proud son of the Garden State, Gregg Stone is joining us as well today. Greg, welcome to the show.
Well, thank you.
All right. And Greg, before we jump into this property, you know, you've been here plenty, right? So we do the regular intro talking about if you want to find out about owning rental income properties, you're definitely in the right place today. If you want to find out about best in class property management for rental property investors, you're in the right place. If you want to get an edge in the Jacksonville red hot rental property market, you're in the right place. Next place to go to get a personalized discussion about it is book a call on chatwithjwb.com. And now it's time for, you know what time it is, right, Greg? It's the roll call.
Greg's like, what did I need to do? Oh, no, I wasn't prepared.
Of course, the roll call.
All right, we got Michael Kubota is back. Welcome, Michael. Good morning. Anthony Ditta, happy Thursday, gents. Good to see you in the house. Jay Cohen, the father of Gregg Cohen, is in the house. It's a family affair. We got Joanna, our community manager. She's here to help you if you're in the chat or you're interacting or you need anything like a past episode or some extra information. Check in with Joanna. If you're new, let her know she's here. So you're here so she can welcome you to the family. We got Drew Barnhill tuning in from Hotlanta. We got Leo, good morning from California. We got Carl Thompson. Good morning, everyone. Looks like everyone had a great time at the Jacksonville get together. We'll talk a little bit about that.
That we did.
We will. Yeah, that we did. Peter James is back. Top of the afternoon to you and happy Thursday, Peter. John Henning is back as well. Good afternoon. Greg, good luck on the Fortune Builders webinar tonight. You on a Fortune Builders webinar?
Thank you. Yeah, they asked me to join the coaching call, so I'll be there tonight. It starts at 4 p.m. Pacific and 7 p.m. Eastern, so join me there.
I don't know why you don't tell me these things ahead of time, Greg. I'm just totally shocked. All right, Ken Moline is back from Good Morning Friends. Lee Bishop, the astute, Lee observant Lee Bishop, MVP of the Not Your Average Investor Show community. He's putting here, Pablo biting his lips again. Man, does he work hard. It's true. The how hard I bite my lips is a absolute factor to how many times we change the layout of the studio here.
Absolutely.
And he says, hello, Mr. Stone, Lee Bishop says. So hello.
I love how he just like finds ways to constantly make fun of you, which is great. And then he goes real professional for Gregg Stone.
It's my favorite. I love
this.
You know, being made fun
fantastic.
of is the way that I build relationships. Leslie Wilson's here from Denver. Who else we got? We got Carlos Andres Lopez. He's back from Lima, Peru. Saludos desde Lima, Peru. Saludos to you. Debbie Allo. Hi, Pablo. Mom is here too. All right.
You want to know who that is? That's my mom.
That's mom.
There we go.
All right. We got mom and dad. Full on family affair. They must be very proud of you, buddy.
Well, you know.
Yeah. I love it, man. Okay. So we got everybody in the house. The usual Not Your Average Investor Show community. We alluded to this earlier. Greg, we missed you on Friday for the Not Your Average Investor Show get together. We talked a little bit about it. Are
we going to try to make him feel worse now for him not being there or what?
I don't know. What'd you see as a watcher of it? Did you kind of check in the Facebook group or anything, Greg? Did you see what was going on?
No, it was a busy weekend for me. Sorry. I wasn't able to follow along on the Friday, you know, full day of work and then Saturday running around with my daughter and stuff on a couple of different things. So I didn't get a chance to check it out.
There you go. Too cool for school. That's cool. That's all right. That's all right. We had a really, really good time, man. Like that was a magical kind of moment of about 30 people coming together, doing the tour of downtown Jacksonville, getting together at Casa Marina. A few of us made it out to some later late night libations. I was supposed to be karaoke that ended up just being a live band, but it went really, really well, man.
You know, it's an incredible thing too. And we talk about how, you know, Pablo and myself, we fancy ourselves as marketers out there and as sales professionals and as about business, you know, entrepreneurs and building a business. And when you fancy yourself as those things, you tend to think that, you know, you can put a great marketing campaign together or whatever type of sales campaign or whatever. And that's what it takes for people to show up and pay attention. And the coolest thing about everything that we did last Friday was completely drawn from the community. It was not pitched. It was not a big sales event. It was just organic and authentic and real. And we all got together and had an absolute blast. So, you know, there are a lot of marketing campaigns out there. I've spent a lot of money trying to get people to show up at places or listen to me. This was the best campaign that we ever did, and not a single dollar was spent. So thank you to all of you who came, and I can't wait for the next one.
Yeah, can't wait for the next one. But enough about us. Let's talk about the star of the show today, Gregg Cohen. Why don't you just tell us, Gregg, how would you consider yourself as a rental property investor? What got you started investing in rental properties?
I have been dabbling in real estate for quite some time. I've bought a couple of summer places that, you know, rented out, and, you know, they've kind of come and gone, you know, based on market changes and those kind of things. But in terms of looking at it as a passive investment, that didn't happen until basically last year for the most part. You know, I was looking at real estate as a potential for, you know, maybe a transition position, you know, maybe something to do in retirement. But I needed to learn more. So I was searching around, and actually I work in New Jersey over by Morristown, and the Fortune Builders was having a seminar that I attended. You know, they were talking about real estate investing and those kind of things. So it intrigued me. So I joined them, and then, you know, ended up joining up with them and started tooling around their education process and learning more. And one of their modules was about passive investments for real estate. And that intrigued me the most out of the whole thing, because, you know, in terms of real estate investing, you know, I know a lot of people are into the, you know, buy, rent, renovate, you know, rent it and then refinance and all that kind of. So that whole BRRRR method, it's intriguing to me. I'm not a DIY handy kind of guy, so you know, building a team like that is a lot of effort, I think, from my perspective. You know, I don't have, you know, those kind of construction kind of contacts and those kind of things to really say, yeah, I'm going to go out and build a team and do something to that effect. It intrigues the hell out of me. I would really like to get into it, but, you know, with a full-time job, I just don't feel like I want to spend another full-time job learning that aspect of construction and understanding and building that kind of a team. So the passive income aspect of it was really what turned me on the most, and through working with Fortune Builders, they ended up leading me to a couple of different companies, and JWB was one of them. You know, they work with various markets around the United States, but I think that Jacksonville kind of fit the bill for me in that it offered two aspects of it. You know, one was really, you know, the passive income aspect of it, but then there's also the appreciation aspect of it. So, you know, you can go into markets and buy properties quite cheap, rent them out, and it'll generate a good passive cash flow, but you won't end up on the appreciation side all that much. And, you know, so from the end of last year is really when I started working with JWB, and I ended up purchasing my properties the beginning of this year. And so far, it's been a great experience.
And we're happy that you're here today, you know, jumping on the show here. That's not easy to do. And of course, we're so thankful for your trust. And I got to meet your beautiful wife, Karen, here a little while ago for the first time as well. So that's really amazing to have you both there. I think she's off camera there, but I think she's listening. So she's listening.
She's here.
So that's wonderful. You know, you brought up a couple of things that I think are really worth kind of mentioning and reiterating. I was just hearing about how you went about this decision. And you went about this decision in a way that really leads to long-term success in rental property investing. That's very different than how most people go and invest in rental properties. Most people start with the property. They spend a lot of time on the property. They do their due diligence there and they make a decision there. After that, then they start to actually think about maybe the market. Maybe I'll understand a little bit more about the market that I've already invested in. convince myself that maybe it was the right market or not. And then lastly, then they focus on the long-term management and the team behind it. But you did the opposite, which is what I would encourage all of you to do and follow, just like Gregg, is focus on your team first. So for Gregg, he had the pleasure of starting to work with Fortune Builders, which is a wonderful organization that we are very big fans of, and they're very big fans of us. By way of that relationship, Gregg was introduced to JWB. So he had his team down. Once he found the team, then he started to analyze the different markets out there, and he found Jacksonville to be that market where you could have cash flow and growth, that home price appreciation, and really benefit from all 5 profit centers. And then lastly, we're a year into this relationship with Gregg, and he's got 3 properties already. Like how cool is that? That's really hard to do in this environment where people don't have inventory normally, or have to spend hours and hours and days and months and years trying to make offers and get them accepted and whatnot. But when you go through that strategy of team first, market second, then property, this is that success story that you can have just like Gregg.
Yeah. And I think to add to that is somewhat, understanding your goals, or the aspect of why is it that you're doing what you're doing here. For me, I'm looking at it, longer term retirement income kind of situation. And, so I have a goal on numbers of properties that I'd like to have, and I have other investments that are going to help supplement that retirement type income. But I think, these properties that I end up acquiring are going to be kind of core and central to that.
Makes a lot of sense. Is that familiar to you?
Sounds very familiar. Sounds like the customer journey for a quintessential not your average investor.
Absolutely.
Yeah. Gregg, while you were weighing in on this decision, so Gregg kind of just broke GC. I'm going to just call it you GC and you Gregg,
like
so that we're surrounded by Greggness here. Were there any moments that you had some kind of like doubt of, is this market too hot? How am I going to buy something in the middle of COVID that I haven't flown down and like knocked on the walls and see if it doesn't fall down kind of thing? Did you ever have kind of insecurities like that?
Not severe insecurities about that. People have asked me, it's like, how could you buy a property without even seeing it? For me, that was kind of a leap of faith and the trust that I've placed into JWB. I think as an organization, they've been there for quite some time already. They have many properties under management, so I felt a much more comfortable about that. It is a strange process to go through and say, hey, I'm buying a property and I never stepped foot in it, haven't inspected it. I've only seen pictures of them. So, I'd like to, eventually I'll make a trip down and visit my investment properties to see what actually did I buy. But, it's something that you have to take a look at. Why is it that you're doing it? And for me, I didn't have a fear of the market there because we're buying the properties right. They are cash flow positive on the outset. So if property appreciation drops, I'm not worried about it because I still have the cash flow that's supporting where I bought it at. So from that aspect of it, I think the risk is kind of mitigated in that respect. So for me right now, I think my biggest risks are, related to the people that are living in my properties. What damage can they do? Can something happen that they're going to end up causing me some headaches, some litigation down the road or something? I hope that never happens, but it's a potential. And I think that kind of potential ends up leading people out of real estate, saying, too much of liability. I know from my own personal experience, my mom and dad, they had the opportunity to purchase a couple of different properties throughout their life. And, they never pulled the trigger because there's that aspect of it. Well, what if you get a renter in there and you can't get rid of them? Now you have the liability of the property and you have no income to support it. So, those kind of things do weigh on you a little bit, but I feel that we bought them at the right time, low interest rates, great market, appreciation has been there. I go on Zillow every once in a while to check, say, okay, what is Zillow saying that my property is worth today?
That's been fun this year. I
And
would
it's been great.
Instant emotional boost right there for anybody who owns
Exactly.
properties. You go and check Zillow every 6 months.
Yep. So
Note to self, check Zillow on my investment.
There you go.
I'm so bought into this whole thing, right? That my two properties, I live in Jacksonville. I haven't gone to see them. I haven't even
Check
looked,
Zillow.
I haven't even looked them up on Zillow. I feel like a real idiot,
I
but
appreciate the trust, bud. I appreciate the trust.
it's hard not to trust you guys when I get to hang out with this team and see amazing people that I get to be guilty by association like Greg that are making the same decisions that I'm making and whatnot. All right, but enough about us. Let's go to the property. All right, let's magically whisk ourselves away here to 5114 Doncaster Avenue, Jacksonville, Florida, 32208. Let me know in the chat if it's clear. If it's not clear, I'll start zooming in on some areas as well. Joanna, our community manager, has posted in the chat the property sheet that you can download so you can follow along and fiddle with it at home. If you're listening on the podcast, go to jwbinventory.com. You can download the sheet yourself and follow along as you're listening to this while walking your dog or driving or something like that. All right, so it's purchase price of $165,000, 3-bedroom, 1.5 bathroom. It's got a driveway. It's got a lease of $1,100 a month. And over here, we see a picture of it. You can tell that this is one of these renovated properties, right? Like lower price than we've been seeing in a while. Renovated property that doesn't look like a quintessential new construction JWB house. So it's cool to see one of these again. And the show, what you're really coming for here is this estimated conventional total financing monthly cash flow of $123 and this estimated conventional financing total ROI of 8.38%. Greg Stone, when I show this property here on the screen, what's the first thing that you're looking at? Where's your head going as an investor when you're looking at this thing?
is it available? Can I buy it? To me, I think, again, I look at it more from the cash flowing aspect of it. So I like the idea that, yeah, it's still cash flowing. You're talking about an 8.3%, ROI there. To me, I would have no reservations looking into this further. My hurdle right now is I purchased 3 properties already this year, so I'm kind of tapped out on my available funds for investing at the moment. So that's what would be holding me back from buying something like this at the moment.
All right, so let's pretend that you had it, right? What would you? So you're looking at it. You like the ROI number. You like the cash flow. Is there anything else that you look at? Is there anything else that you considered when you were first starting to get shown properties, or any questions that you would have had going into this?
Some would be related to what is the condition, but I know that JWB does a great job of doing the renovations, and I think all three of my properties were renovations.
Yeah,
I
think that's great to point out too. So for any of our folks in the audience who have questions about why should I invest in a renovated property like this one, you've got an opportunity to talk with Greg, who has literally lived this out 3 times this year. So would highly encourage you to use Greg as a resource and throw some questions his way.
Yeah, that's right. And I haven't, I kind of missed on that one. This is an interactive show, right? We are picking Greg's brain. We have GC here to answer it from another level. I'm happy to moderate it. So make sure that you're using the Q&A if you have any questions, if you have anything that you want us asking either of the Gregs here on the show as we're going through this. So when I look at this estimated conventional financing total monthly cash flow, Greg, what do you think of that $123 number? Does that, you mentioned something about cash flow being like buying it right. Does that compare to the cash flow that you initially got from your first couple of properties? How do you consider that
one? That's right around the neighborhood of where I've been with my other 3 properties. I think it's actually a little bit higher.
Okay.
So for me, I would look at it and say, well, okay, it's 123 a month. Not life-changing at the moment, but you start to stack 2, 3, 4, 5 properties together, and you start cash flowing that. You're paying down the principals without using your own cash. I love that idea. I'm sure that we'll get some price appreciation, but if it doesn't appreciate and you sell it for what you bought it at, 5 years down the road or 10 years down the road or however long, or if you ever sell it, you know, there's still that value there. So, you know, I'm not really too worried about the price appreciation on something like this too real much, you know. You know, my concerns would be, you know, how is the heating system? How is the electrical, you know, what kind of additional renovations need to be done? What has been done, you know, and look at the life of any of those types of systems, you know, because that's what is going to end up eating into your return for a particular year. You know, if you buy something and get hit with a major renovation early on, well, it could be hard to weather that kind of storm. And, you know, I think we've seen in some past shows where somebody had that exact kind of situation, but they still eked out 1 point something% ROI, you know, for that one particular year. But they had a lot of, you know, there was a lot of stuff that had happened, you know, in terms of those systems repairs. I like the idea of new properties. You know, you put in everything's brand spanking new. You don't worry about the maintenance. Yeah, that sounds great, but you know, you pay a price for that. And that's why I kind of like the idea of this situation as well. You know, you look at the purchase price, it's below a new construction for the most part. Means a little less for me to be able to get into it, and you're still generating a passive, you know, positive cash flow. So who wouldn't love that world?
Was that a part of your plan? If you could take us back to when you were planning this out with, I think you were speaking with Mike Stetson on my team at that point.
Yes.
It's like you got to a really important number of properties in the first year, which is 3 properties, because we teach and we coach and we train that consistency really happens once you get to 3 financed properties. And prior to getting to 3 financed properties, an individual property is never going to be consistent over the long haul, because you're going to overperform when a resident's in place and the rent's coming in. And then when that resident leaves, which will happen for every property at some point, that's going to be a down year, right? And you factor in maintenance costs and things like that. That happens in that down year when residents leave. And if no matter how good your property manager, when you only own 1 property, that is what you're faced with. So when we can work with clients and we can look at their plan and understand their resources, and there's an opportunity to get to 3 properties, that's certainly where we're going to go. It's going to benefit everybody there. So I would love if you could take us back to that planning conversation that you had with our team and let us know, was that a strategic move for you to focus on renovated homes just to get to that point?
I think in some respects, yes. You know, so for me, I was sitting on a chunk of home equity that I said, you know, working with Fortune builders, and you know, you kind of change your mindset and you start thinking and looking at things a different way. And you know, I had quite a bit of home equity, and I hadn't capitalized on doing any refinance at that time. So, you know, I looked at, well, how much can I get out if I do a refinance? And I ended up refinancing my home, taking a bunch of cash out, and still lowering my monthly mortgage payment. So I was like, damn, this is great.
I love that.
And so I talked with Mike. I said, you know, and I said, here's how much I will potentially have to put into this. And I wanted the most passive income for that price. Mm-hmm. And, you know, I think I ended up with the renovated properties because I could get, you know, a little bit more economy of scale in some respects, you know, three properties. Absolutely. And as you mentioned, you know, I had already, I this year, you know, my first year in, have already experienced a property turn. You know, one of the properties was already, two of them were already rented. I should say all 3 were rented by the time I closed. Which was great. You're cash flowing right on the onset. But one of the properties had a property turn in October. So the end of October, they were out. And so I would have been left holding the whole bag. But since I had the other 2 properties feeding into it, it wasn't as big of a hit as if I had only owned 1. So for me, it was more of, you know, making sure that I had that scale, and I'd still like to add 2, maybe 3 more properties to my portfolio. I'm just not sure when that's going to happen. But I know, with price appreciation that's been going on there, waiting longer is going to cost me more down the road. But, things being what they are, that's how it's going to end up having to be.
You hit on a number of really great points there. I think we could probably spend the rest of the time just talking about those 3 or 4 points. Like when you were saying things there, I'm like, oh man, he gets it. He gets it about this. And then, I listened to a sentence longer and I'm like, man, that's such a critical point for people to get. He gets that too.
So what are the points? Give us the point.
Well, the last one, when he was talking about the effect of rising prices and rising interest rates, and he's talking about how, the longer that he waits and longer that we all wait in a rapidly appreciating real estate market, the higher the cost of the debt and the lower the return on investment and the lower the cash flow, right? That's been a steady progression that we've seen. We've talked about it for years now. And that's really the environment that we're in. You think about what Gregg said originally in the call here, he talked about why he loved his assets and why he decided to buy this year, which was a new thing for him. And he talked about interest rates being low. That was the first thing he said. Right. So he gets the debt component of it, right? He gets he understands what's going to happen in the future when you have prices rise and you have the debt cost rise, even though rents are rising. It's not going to keep up. So your return is going to go. So the best time to buy, I believe, is right now. Gregg, you've done an amazing job with those 3 properties. I also wanted to hit on just simply how he took a home equity line of credit and used that as the ability to now form his rental property portfolio. Because if you combine both of those concepts, there are many of us that have equity in our homes, right? As a country, real estate values have gone up. No matter where you are in the country, good chance that you have more equity in your home today than you did a year ago. And for some of us, it's sizable equity. Well, one of the concepts that I teach is that your return on equity is 0. Your return on equity is 0. What that means is if you have equity, specifically in your home, and you do nothing with it, you're not able to earn a return on that equity, right? It's great to have it, but how much better would it be to be sensible, to be responsible, but also use that equity and turn it into an income stream for you? And how cool would it be to learn this concept today or learn it right now in this market, use that to go and buy 3 properties at low interest rates today where you lock in. I was looking at Gregg's interest rates, somewhere around 3.5% on the new properties. That doesn't go up when home prices go up in the future. So yeah, I'm a big fan of you, Gregg. Your level of understanding and comprehension just in 1 year beyond just buying the rental properties. I mean, you talk to a lot of people who just buy stuff and they don't really know why they buy it.
You talk to one guy every week.
Well, probably you're listening to Gregg. Gregg knows what he's talking about.
Yeah. Man, all right. So a couple of places. Speaking of this topic, last night we got together about 8 of us from the Spike Ball crew, and we did this strategic planning session for 2022.
Nice.
And when it was my turn, I was talking about this idea that I want to acquire another property in 2023. And it could be, as you may or may not know, if you follow the show, Gregg, I don't own my home in Jacksonville because my wife and I have not found the place that we want to live, that we can afford, that makes sense for us in our financial situation. So we've been investing in rental income property. So I was saying that whether it's buy my own home or it's buy another rental income property, I want to acquire another property next year. And they're like, well, have you ever thought about selling your investment properties to acquire the home that you want? And I'm like, you know what? I don't know if I'm saying this correctly, because again, that room, it's pretty heavily real estate focused. So I'm like, I feel like you guys know more than I do here. But I see myself, I think it's more likely that at some point that I am going to buy another rental property. And at some point, regardless of how crazy the market's gone in Jacksonville, I'm going to be able to take home equity from my rental properties to buy my primary residence, as opposed to selling my rental properties to buy my primary residence. Am I crazy thinking that?
Yes, with a caveat. No, you're not crazy. You're not crazy. That is possible. That's a great strategy.
Okay.
What you're talking about is building a rental property portfolio, and you're profiting from all 5 profit centers, right? Mm-hmm. One of them being home price appreciation. And you're saying after 3 years or after 5 years or after 10 years, can I then take the home price appreciation, the equity gain there, and then reinvest that in future properties? And the answer is yes. The only caveat that I was going to offer is when we're talking about a home equity line of credit, that typically is not allowed for investment properties. That is only allowed on your primary residence, based on the way that the lending environment is today. Hasn't always been that way. In 2006, when I started to buy rental properties, you could actually get HELOCs or home equity lines of credit on investment properties. So what you would do is you would just do a refinance.
I would refinance.
You would refinance.
That's a different thing.
Yeah, that's the only difference. And that cash out refinance is the product that you would use to do. And lots of our clients are using them this year, right? We talked about it with Rich Ritchie, right? Right. He was on the show originally and he was talking about how he was refinancing, pulling cash out of his rental properties to then go and add to his portfolio to build out his portfolio again, because he's locking in low interest rates on the next purchases as well.
Can we have a quick, what's the difference between a home equity line of credit and a cash out refinance? Yeah,
absolutely. So a home equity line of credit is just it's a line of credit. It's not a new mortgage in a sense, right? Like a line of credit, right? Do you have any lines? Have you ever had a line of credit?
Yeah, man, I got an Amex Platinum.
Okay, there you go. Yeah, line of credit. If you use the money, you pay for the cost, right? You pay interest on it. Okay. If you don't use the money, do you pay anything?
No.
So a home equity line of credit allows you to basically access that equity that you have in your house, but you don't have to pay the debt costs unless you use it. So it's a beautiful thing. And for those out there, if you're thinking about getting a home equity line of credit, I think it's one of the best things to do, even if you don't use it. Like I have a home equity line of credit on my personal house. I get it all the time. Like every time I have a huge equity gain in my house, I go and I get a higher home equity line of credit. Doesn't mean that I use it all, but it's there for me. If I see an investment opportunity or if there's something else that I want to do, then it's there for me. And it costs sometimes nothing to set up. Sometimes the costs are there, but really, really small. So that would be a home equity line of credit. A refinance is a brand new loan, right? Let's say you had a loan on your property for $75,000 for your original property. And then after 5 years, the value has gone up so much that you can now, the bank's going to lend up to $100,000. Well, they give you that new loan at $100,000 and that cashes out that 75. You walk out with 25 in your pocket, but now you have a mortgage payment to make every single month on that $100,000 loan. No matter what you do with that money, you're always making the payment to the bank.
Okay, that was pretty clear.
Yeah, man.
That was pretty clear. All right, let's get into Greg. You touched on the profit and the difference between this cash flow and the total ROI. Do you want to take a stab at how well you know the profit centers, Greg, and kind of how you estimate the different ways that you're profiting from this investment?
Well, you have 5 of them, right?
That's right.
So home price appreciation. So your first year, you can't really rely too much on that happening all that well. Although in this market, my first year home appreciation has been quite impressive, I'd say. So I haven't been relying on that, but so there's that aspect of it. You have the buildup of the equity as people pay off your mortgage for you, i.e. your renters. You have your tax savings. You have, your positive cash flow and inflation hedged out of you.
Good job, Greg. The reason why I wanted to get to that is because we've talked about this cash flow. We've talked about this ROI. Greg, you yourself said you came to Jacksonville for home price appreciation. It was a big part of the equation, but we got this 0% appreciation rate. When you got presented properties, how did they explain to you why this 0% appreciation rate is here, and how do you still factor that in if that is what you came for?
I don't necessarily factor it in. To me, that's like the extra bonus gravy on top, if you will, kind of situation. I understand that you have to really look at it from more of a longer term perspective to really understand or capitalize on that appreciation rate. So at the onset, I'm okay with accepting a 0% in there, because you're not looking at least when I first looked at it, I didn't look at the appreciation as being a key factor in purchasing it. To me, the Jacksonville market offers that appreciation, but it wasn't a key factor for me at the moment to really say, yeah, I want to purchase a property there. You know, in hindsight, when you look at it a year down the road and you say, hey, appreciation was what, 8 to 10%.
Even higher, but yes, you're there.
You're looking at it and say, oh, this is actually even better than I had hoped. So I take that as a worst case scenario. If you get 0% appreciation, as I said, you're still cash flow positive on this. So to me, you still have those other profit centers working for you. So if one of them misfires, so be it. I'm not worried so much about that aspect of it. But in terms of potential tax savings, the potential for the keep the build of the equity and the positive cash flow, to me, those are sufficient in and of themselves to make this worth my while. So that's how I've kind of approached it and took a look at it. And that's almost when I looked at any real estate that I've actually purchased, even like my primary personal residence, I didn't look at it as, well, the long-term appreciation is going to be something that I can count on for down the road. I look at it as, even like my personal, my primary residence, I don't look at the appreciation per se. To me, it's a place where I live, my shelter. It's a store of value in some respects. I would hope that it doesn't go down, but you do see down markets. We had purchased this house basically at a very bad time in some respects. Just before the 2009.
Wow.
It was around that time frame, and you start to look at it, and real estate prices had gone, continued to plummet afterwards.
Mhm.
But like I said, I was buying it for a specific reason. It wasn't for the price appreciation at that time.
Mhm.
And that's how I kind of look at these. I look at them, my primary interest right now is the cash flow aspect of it. The appreciation there is a secondary aspect, although it is an important aspect to me as well. And that's why, that's what drew me more to the Jacksonville market rather than, investing in elsewhere in the States. So that's, there's
I'm
a
really
couple of
curious.
trade-offs there, but that's why I decided on Jacksonville. It is because of that price appreciation kind of helped tip it over the edge. I didn't want to look at it only from a cash flow positive, because if you were interested in cash flow positive, I think there's other markets in the States that you can do a hell of a lot better in cash flow, but you're not going to see any price appreciation.
You nailed it. You knew that was my question. I was wondering, I know you explored multiple markets. Did you have the opportunity to use your investment dollars to go and generate more cash flow elsewhere, but decided against it because of all 5 profit centers?
Yes.
Yeah. And that's a beautiful thing, right? We openly talk about what markets are right for what investors. And if you are absolutely cash flow is the only thing you're thinking about, Jacksonville is probably not the best market for you. But if you're thinking bigger picture, if you're thinking all 5 profit centers and you're thinking long term, clearly we have a winner here in Jacksonville. The other thing is that I could really relate to from what Gregg was saying was this concept. This is how I felt about rental properties when I first started. I was like, I really like to make decisions based on what I can control. And I like to have upside for hopefully things go in my favor. And at the ultimate, if I'm hearing you right, Gregg, that's kind of how you went into this decision, right? I have relative control over rental income, relative control over tax savings. Pretty sure that's going to happen every year. Control over principal pay down because I know what the terms of the loan are. Inflation hedging is there even more today than we thought, but it's always been there, right? Things have always tended to devalue the dollar. And so when you looked at that, I would imagine you compare that to your other investment alternatives and then became a win here. And then, oh, by the way, we have this potential for really big upside in home price appreciation. Could you kind of shed some light on that? Did I put words in your mouth there, or is that largely how you went about it?
No, that's pretty much what I was looking at. Again, to me, as you said, you know what you can control, and appreciation, you don't know if it's going to be there or not. I can't control that. but at least I can control going into it. I know how much I needed to put down to generate a certain cash flow. And I knew that that was covering my mortgage, interest, taxes, insurance, so it covers all my expenses, and I come out with a bonus at the end of the month. Hey, to me, that was, it's a no brainer. If you say you're going to pay me $100 a month, I'll take it.
Sure.
If I could get into a situation where it gets to a point where it's going to end up paying me $400 or $500 a month, even better. But that's why on the long-term look at this, as I pay down the mortgages, at some point I could refinance possibly, and buy 2 or 3 or 4 more. And that's maybe what I'll end up doing.
Sounds wonderful.
Yeah. All right. So I'd love to do a couple of things here. I want to talk about appreciation and how to consider it if you are going to consider it. Lee's got a great question in the Q&A, and then let's dive a little bit deeper into Gregg's story. So yes, appreciation, bonus, right? We talk about it all the time. It's at 0% here in these property evals that we like to talk about. Gregg, you explained it as if you are in it for the long term, you just go to the historical average, right? For one full housing cycle, Jacksonville's historical average is 4.3% appreciation. You don't put it in the evals because you don't control the length of time that somebody's going to own these. You own these homes outright, right? But if you are going to own it for 10 to 20 years, you can think about it as 4.3% pretty safely. So we put in 4.3% here if you're in it for the long haul like Gregg is, and boom, it shoots up to 24.68% on this estimated conventional financing total ROI. Gregg, have you done this whole thing and kind of like played around with those numbers like we do here and think about this this action long term? Can you explain why it went up to 24%?
I do play around with all those numbers, but I couldn't explain it per se, other than that, if you start looking at the price appreciation, that starts to factor in the amount of equity that you end up having in the property, and then, the amount of your investment, is kind of diminishing as well. So, but as your equity is increasing, so that's why your return is going to increase.
Well, we got a backup Gregg to explain that one. Backup Gregg, you want to explain it?
I'm just glad I have a purpose for being here, because Gregg has absolutely nailed this entire conversation. Let me kind of help here. All right. So you're on the right track, Gregg. Really what we're looking at for your return on investment, let's think about how a return on investment calculation is achieved, right? You've got your return and it's on the top, right? And it's on your investment on the bottom, right?
Return on investment. All right.
Return is the numerator, investment is the denominator. All right. But what we're talking about here is the beauty of using financing, using smart debt like Gregg has, like I'm a big proponent of now, even more than any other time, because it's the most advantageous terms in history. And when we think about how to calculate a return on investment, let's just keep it simple and say historically that values have gone up 4%. All right. If you own a property and you bought that property for $100,000, let's just say to keep it simple, and it went up 4% in that year, Pablo, what's that property worth after 1 year?
$104,000.
$104,000. What would your return be from that appreciation?
4%.
Well, 4%, and then a dollar figure would be $4,000.
$4,000.
There we go. Right. So your return is $4,000, right? Top number. All right. On the bottom, you've got the investment. Now, here's where it gets really fun, depending if you're using a cash purchase or if you're using smart debt. If you're using conventional financing, smart debt, leverage, these are all the same terms, right? Well, if you bought that property in cash, Pablo, how much did you pay out of your pocket for that $100,000 property?
$100K.
$100K. So your return on investment just from the appreciation is the $4,000 number over $100,000.
That's right.
Right. So your return on that home price appreciation is
4%.
4%. Right. Now you've used conventional financing.
I have.
Right. Gregg, I know you have as well. Thank you for allowing us to look at your information. We'll be sharing that with folks here in just a second. How much did you put down on your property? Was it 20%?
20%.
Okay. So let's just say that you put 20% down. Let's use the same $100,000 example. All right. After 1 year, it goes up 4%. The market value goes up 4%. Real dollars, what did you earn? What's your return?
Real dollars still 4,000.
4,000. So the top number is still 4,000. But your investment is not $100,000 now because you only put down 20%, right? 4,000 divided by your initial investment now is what? $20,000, right? Yeah. So let's do that, right? Everybody take out your phone, right? We're going to do this calculation here. You got $4,000 is the return, and we're going to divide it by Pablo's initial investment here, which is
20%.
20,000.
20,000.
Same thing, right? So 4,000 divided by 20,000 gets us
to 20%.
20% return. So while the market value went up 4%, because you use smart debt, your return on investment from that appreciation was 20%. That's why this number goes up from roughly 8% to 25%. The only difference here being that our calculations are built on you putting down 25%. But you can see here the power of smart debt, smart leverage, right? This is why the most wealthy and savvy real estate investors use smart debt to their advantage, because when, we don't make decisions based on what we think home price appreciation is going to be next year, but when it happens, because it does happen over the long haul, we win ×4 or we win ×5. And that's why this is the biggest contributor to your overall return on investment over a full market cycle.
Mic drop, walk away. I love it.
How we do?
I thought that was pretty good. Was that pretty clear, Greg?
Yep.
All right, man. Love it. So let's answer Lee's question and then let's get into your journey a little bit more. So Lee asks, again, with his astute eye of the MVP of the community here, he says, noticed the new numbers for maintenance at 7.5% and vacancy at 4%. And it is a remodeled home. Why is the vacancy at 4%? Is that due to location?
Yes. So the amazing part of our community was here last week when we were talking about the upcoming changes to our evaluations heading into 2022. As you know, we have this data flywheel or database company, and we have the unbelievable advantage of analyzing all of our clients' properties over the last 10 plus years. We do it every single month. We look at what maintenance costs are, vacancy costs are, and we're able to use this to your advantage and to our advantage to better prepare clients. So prior to us doing that new revamp and looking at all the data going into next year, and we're looking at what are historical numbers, what are the most recent year numbers that we've had for our clients, and we're also looking at what is the economic environment coming forward, right? And we're thinking out what's the economic environment over the next 5 years. And we use all of that to set better and better expectations for costs, both maintenance cost and vacancy cost, for all of our clients that are purchasing properties just like this one on Doncaster. So the net effect of all of that is that the maintenance cost increased from 6% to 7.5%. And the reason for that is largely due to increases in materials and labor in construction. Raise your hand out there if you've heard that increase in construction costs and labor costs, right? On construction, right? We all should be raising our hand. Well, that's real, right? We know we are in inflationary times right now, and it's hit the construction industry way more than most out there. So that is a real thing. If I'm sitting here saying, how am I going to best predict how we're going to spend your money or how your investment dollars are going to work next year? I have to look at that. So that's the biggest driver as to why we have increased that maintenance percentage on renovated homes from 6% to 7.5%. On the vacancy side, we also are forward looking. Truthfully, our vacancy rate for renovated homes is actually lower than 4%. Like if I actually show the data here, it's lower. I think it's like 3.2 or 3.3%. But as I'm thinking to myself, I'm not just trying to sell a property today. I'm trying to set the right expectations for clients who hold this property for at least 5 years. I'm saying, you know what? Right now is the very best and easiest time to rent properties, right? That's why you're seeing rent rates rise 8% year over year. I've never seen that happen before. That's why you see extremely low days on market. So as I'm looking at that and I'm saying, all right, I don't want to just think about today. I want to think about preparing folks for at least 5 years of ownership. It is not going to be as easy to rent properties 3 years from now, in my estimation, right? Right now, it's way, way easy. Now, it's still going to be easy for us. We're still going to do a great job of it in 3 years, but it's not going to be as easy as it is today. So I'm looking at that and I'm saying, you know what? I'm going to be conservative and prepare folks that, you know what? Vacancy costs probably will go up to 4% at some point, strictly for renovated homes. And so that is a long-winded answer as to why vacancy costs have increased to 4%. It's an extremely conservative way to look at it, and it's long-term, and it's really taking into account market conditions, and the same thing on the maintenance rate side.
Great explanation, man. Great question, Lee. That was awesome. As we transition now, Gregg, more about you. We're going to pull up some of your returns right now, but I'm looking at this comment by Denny Davis in the chat saying, when we're talking about leverage and we're talking about this idea that you're getting 20% just based on the leverage piece and historical appreciation, right? Really mathematical, that the stock market averages 10%. So you're like doubling that just based on leverage. I would love to know, Gregg, you talked about you've supplemented your investment portfolio with these rental income properties. Can you tell us a little bit about the rest of your portfolio as we pull up the returns here on your rental properties so far?
They're mixed. It's all over the place. You know, I play around with stock options. I'm in a lot of different kinds of types of things. You know, some of it is, you know, you look at it from a 401k perspective, not much I could do in there for the most part. You know, it's locked in with the company and you're invested in only specific funds. Some of them do well, some of them do bad. You know, I think this year the average has been around, I want to say about 18% maybe, or thereabouts in that. I have other aspects in terms of like, you know, a Roth or a traditional IRA, that I kind of locked into some more conservative type of investment. And that's only been, I think, returning around 8 to 10%. But I did that back when the market was all kinds of crazy. So I was like, well, let me take some money off the table. I was able to do an in-service withdrawal, and I moved that into something a little bit more stable, you know, just for somewhat peace of mind on my aspect of it. Then, you know, you talk about cryptocurrencies, they're up, they're down, they're all over the place. So I don't know where I am with those, but I know that they are pretty much all positive. But, you know, you take a look at what Bitcoin has done in the last year, you know, it's quite phenomenal. If I can get real estate like that, that'd be awesome.
Yeah.
Well, in the metaverse, you may.
I mean, if you look at, you know, you've been investing this year, I'm just going to ballpark it and say that you had 15% returns from the appreciation on it.
Yeah.
You know, and you put, I don't know if you put 20 or 25% down, but you can multiply that times 4, you know, 4 or 5, depending on what you put down. So you're not, people don't think about it. And I know you're not going to go rush to the bank and sell your properties and all that good stuff. But like in a year where Bitcoin's making all these incredible returns, properly financed real estate in a growth market like Jacksonville actually been kind of close.
It's been exactly. That is interesting. That is interesting. All right. So now we got on the screen. Gregg, talk us through this. What are we looking at?
So this is a great way to kind of cap the call here. Gregg talked about how important it was to start with a plan and to start with the right team and to start with a strategy. And he mentioned how he knows how many properties he wants to put into his portfolio. Well, that's a function of us working together and coming together to build that plan even before we start to actually buy properties. And so we go through this process, and you know, through that wonderful process, we were able to identify why Gregg is investing. And that's what you see here with the client's why, you know, and he mentioned retirement, and obviously leaving a legacy is important to him as well, which is an incredible goal there. We then take that and we break it down into a monthly passive income goal. There, we then break it down again and we say, okay, if we're going to generate $7,500 a month, then we need to break it down into the number of properties that need to support that. And then, of course, we look at the resources that we have and we put a plan to get there. And we're very goals-based and milestone-based. So for Gregg's plan, his year to achieve his milestone is 2031. He's got 3 properties now. I believe your current milestone is 5 properties. It sounds like that may actually be going up. Gregg, I'd love to hear some more color on that. And then the next thing is your date of next purchase. We're always very in tune with our clients, understanding when the right time to buy that next property will be. Did I miss anything there, Gregg?
Nope, that was it. Yeah.
Cool.
All right. So that's it. So this is the KPIs for year 1. These are the properties themselves that have been purchased, right? So got 1 in January, 2 in January, 1 in March, right? Kind of looks a lot like me, except 1 in January and 1 in March. And These purchase prices look a little lower than what we're seeing.
Yeah. Remember that? Remember when we had some of those properties back in the day?
I remember those.
Those were the really low price renovated homes.
Yeah.
Yeah. Tough to find now. Super happy that you both got some really low price ones,
did,
right?
yeah.
Remember what your purchase price was?
Like 120.
122,
something like that. Yeah.
Haven't seen one of those in a while.
Yeah. Haven't seen one of those in a while. Anything particular in these, Greg? Have you said that you haven't come down and seen these, right? Has the experience on these properties has anything differed between one to another?
No, not necessarily. Although, aside from the property turn on, I think it was Ontario, as I said, when I purchased it, it was already leased, and that lease was ending in October of this year. So they didn't renew. So, it was vacant for, fortunately 2 weeks. The team did a great job. They got it in, cleaned up, fixed up, I can't complain, and rented within 2 weeks.
You like that?
How can you go wrong?
Yeah. That sounds like a good one. And then finally is the total ROI so far. GC, you want to kind of explain what this is?
Yeah, this is our scorecard. And I just wrote an article for the Jacksonville Business Journal here recently. It's going to be coming out soon. And I talk about this portfolio mindset. That really is what separates real estate investors from a portfolio manager and really long-term success. It prevents you from knee-jerk reactions. It prevents you from emotional decisions, which tend to cause us to make unwise decisions, at least for our return on investment. Well, what I mean by a portfolio mindset is, we're going to be adding properties to our portfolio. Greg has 3. Clients generally have 3, 5, 10, 20 properties in their portfolio. When that happens, we need to be very honest with everybody and let you know that if you own rental properties and you have families living in those rental properties that you don't know, and you have 10 or 20 and you hold on to those for 3, 5, 10, 20 years, something bad is going to happen in every single one of those rental properties. I guarantee you. I have over 300 of them. I know this from experience, right? It's going to be unforeseen. And when that happens on that individual property, it's going to be a little bit of a roller coaster, right? Prior to it happening, you were going up, right? Returns are up. It's a surplus, right? That bad thing happens, then it goes below and you have a bad year on that one individual property. Well, those who are successful understand that we need to look at this as a portfolio. We understand that on individual properties, you're going to have ups and downs. That's why we get you to have a portfolio of at least 3 properties at the right time for you. And when you do that, you're able to take the approach that if I give my money to JWB and tell them to run with it, and I ask them to hit a certain return on investment, I don't really care how they get there. They just need to hit that return on investment for my entire portfolio. When I do that, I give myself the ability to say, you know what? A bad thing can happen on one individual rental property. But if that happens, there better be 2 or 3 other ones that have more of a surplus to offset that. And if that happens, then we're golden. Then we hit our return on investment as a portfolio. That's what helps you make the best decisions long-term. As we look here for Gregg's portfolio, at the bottom of every one of our client ROI reports, which we produce monthly for all of our clients, you get to see what your total portfolio return on investment is. And so this is taking the weighted average, all the good things, any bad things that have happened in Gregg's portfolio over his first year of ownership. And you can see that his annualized lifetime return on investment so far is 14.6%. And if you took the weighted average of what we told Gregg his returns were going to be over the long haul, that's what shows up at that expected annualized returns number. We told him to expect about 10.9%. Are we right around 10.9%? We're better. Is everybody happy about that? Yes, absolutely. Even if bad things happen on an individual property. That's why Gregg's such a wonderful client. He absolutely gets it. And that's what I really hope for others out there, whether they invest with JWB or not. I'm a big advocate of this asset class. And this is how you have to think about this asset class to be able to make the best decisions long-term.
There you go. Gregg, anything to say to that as far as when you're hearing it, when you're looking at these returns? Do you look at this ROI report often? Is this just kind of something that you know is available, but you don't look at it?
I know it's available. I don't look at it every month. I do look at it periodically though, just to see what's going on, make sure, I go and check to see what maintenance things have happened, or, I always check to see what's going on, but it's not, I'm not a fanatic and follow numbers like on a monthly basis per se. But you know, it is nice to see, you know, that what you expect and what you're hitting is, you know, much, you know, what you're hitting is actually more than what you had expected, and it's always nice to see that.
Agreed.
Beautiful thing.
Yeah, it's a beautiful thing. Beautiful thing was hanging out here for an hour in the middle of a Thursday. You know, we had 30 people on the call most of this time. We just never take that for granted. The ability to pick your brain, Gregg, this was awesome, man. Great to, you know, I see you in the chat week after week. It's great to see your face and, you know, put a face to the name and get to chat with you and tell your story as a fellow, not your average investor. And, you know, like we said, if you wanted to find out about rental income properties, I think you were definitely in the right place today. Definitely in the right place for some property management wisdom for rental property investors. Definitely in the right place talking about the Jacksonville market and the things that are happening. Next place to go is chat with JWB.com. I want to thank everybody for showing up. Gregg, I want to thank you. GC, I want to thank you. Gregg, I want to kind of give you any last words on what this has been for you or where it's going, or anything that you want to leave, any kind of nugget of wisdom you want to give the audience before we give GC here kind of the final goodbye.
The only thing I would say is, if you're on the fence about it, pull the trigger, you know, overcome your fear, you know, take that plunge and go. You know, my only regret is that I didn't start this 5 or 10 years ago, you know. So from that aspect of it, you know, get off the fence and start moving on it. You know, it's been a great experience. I can't complain about it.
Well, Gregg, that means a lot to me. You know, one of the things that's really been tough over the last, you know, year and a half, 2 years with COVID is that, you know, I don't have the opportunity to meet our clients face to face as much. And so it's been really wonderful to get to know you. I hope that we get to have you down here in the office and maybe for the next Not Your Average Investor meetup, because the relationship that you have with my team, it means a lot. We understand the trust that you guys put in us, and very appreciative of your time and your just transparency and sharing your thoughts and your wisdom with the group here. So thank you so much. We hope to have you back again as a guest investor here on the Not Your Average Investor Show. And thank you to the entire community. We'll catch you next week.
All right. See you next week.